Hey, 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 and welcome everybody. Welcome, finally, we're here again. Our favourite live stream of the month, our favourite scalping session of the whole month. 1 hour of true scalping, that's what I like to see it. Welcome to Forex, Forex Scalping Team, www.com for information on how to join our group and gain access to our AX trading system. Haters that are just members. So today, yes, lots of news around on a macro scale, but we're on the payrolls and the average wage earnings. We're logged into gold. That's what we're trading on this one. We're also looking at the third as well, and obviously cable had some good trades on this morning. And nice 30 pip on drop. A lot of bad news reference session, the Bank of England interest rate today. So on that, now it's going to swing west on, which we've got in about 9-10 minutes time. Predictions are a drop jobs market, well, 250 plus a gains in jobs, but less than last month. What they're predicting a slight slowing down in the jobs market, which will lead the Fed to increase interest rates even more. So if we get a miss on the data, we hope we'll get some real big moves. Markets are consolidating in the US mostly. Obviously, at a better expected figure, then we'll look at sells on gold, better than expected figure, take buys on gold. US 30 could go either way. It depends how the market reads the. Like I say, if the result is better than expected, that is good for the stock market, bad because it will go up. So that's why I'm focusing on gold. I always do gold on anyway. So that's where we're set up. We're logged into our broker. We're trading on IC markets. We're a 1 to 500 leverage, and we're going to go in and out as many times as we can on that result. Okay, so set up some levels ready. As you can see, my lips are not moving anymore. Already about 70.88. This is a text to speech voice generated with speech. Nice sell off morning, and 98% of the here look at at some levels where price might do depending on not pending orders. So just to give me an idea, you missed the so here is the deal. For a limited time, trade that you catch up back, but you know eventually. We will sell Speechelo as a monthly recurring service. But today, because you are in the first 1,000 people to join, you get the special founders offer. Basically 35. Speechelo for a ridiculously low one-time fee and no monthly recurrings. Just go ahead and click the buy now button below right now. So that's good enough. Get in any trades. In fact, I'm so confident that I'm going to make this a complete risk-free decision for you. If you create a voiceover using Speechelo and you don't like it, I will refund all your money and let you keep the voiceover that you created. So, now that you have no risk, you also have no excuses. Go ahead and click the buy now button below and benefit from the one-time payment offer. It should be better now. Hey. For the first 1,000 users. And remember, you are covered by our 60-day money-back guarantee. Broker. Bloomberg on in the background.
The Fed keeps on sort of, hanging their hat on the idea that there's, people can find a job really quick. Job openings are not the thing we're supposed to be hanging our hat on. It's a massive lagging indicator. They fall in earnest in the midst of a recession.
That was Tom Porcelli there of RBC going into the payrolls report in around about 13 minutes from New York City this morning. Good morning, Tom Keene, Lisa Abramowitz.
Whatever happens today, if we get a bang-on number, everybody trades as the way they did. But if it's really weak or really strong, that will cause people to start thinking about recession or the fact that the Fed's going to have to
Right.
go more. So be interesting to see what the headline number
See.
is today. And then you'll have this fork in the road. And as Yogi Berra once said, when you come to a fork in the road, take it.
Let's talk about that fork in the road. Mike, when are you expecting to see the deceleration? And I don't mean the step.
Hey, yeah, we're logged into our broker now. Lot sizes, I'm going to go with 0.2 on this. Margin of about $65. Trading with like a $3,000 account. Pip value is going to be 20 cents a pip. But 0.2 I think is sensible. I could go higher. I've gone higher before with that kind of account size, but I want to keep my risk minimum. It's a wrong way, and there's enough there. And I think there's going to be a big move, so that's why I'm predicting that. So,
and I love the paper Yogi Berra gave at Jackson Hole there a number of years ago. Mike, I want to talk about this canard of a fully employed America. It's baloney. Are we fully employed?
Well, the only way you can argue that is to talk about the math of it, because otherwise it's subjective. But the math of it is, yes, we're at a rate of unemployment where everybody who wants a job basically can find a job. There's always going to be people in between jobs. So, yeah, the Fed has a pretty good view on that, I think, and it's hard to disagree. The one thing about Jackson Hole that Yogi Berra also said was nobody goes there anymore. It's too crowded.
We'll be going there, Mike. At the end of the month.
okay, let's see what's going on.
He's going to be standing by to break this down. Mike McKee alongside Tom Keene and Lisa Bramford. I'm Jonathan Ferro. When this one drops, we'll catch up with Mike McKee. We'll get the thoughts of Randy Krosner, formerly of the Federal Reserve, to give us his thoughts on what this means for the Fed. And then the market response too, with Jeff Rosenberg of BlackRock. All of that coming up in about 5 minutes' time. Going into this payrolls report, futures essentially unchanged, up about 0.1% on the S&P. On the Nasdaq, up by 0.05%. Yields going nowhere at 269.36. Yields likely going somewhere.
This is Mark, and this is a car, a sofa, a bag. But since Mark has been trading with Capital.com, he sees a brand, he sees value, he sees an investment. Start seeing the world differently with Capital.com.
In about 4 minutes, your estimate 250K,
yeah.
the number up next.
Three minutes away. Just have these baseline. Trading view down from average down big.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions. Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres tonight with replays all weekend on Bloomberg Television and Radio.
We make it very transparent to the shopper before they accept an order, what the order is going to look like, how much we're going to pay them, and how much like the consumer is paying.
Okay, we've got 1 minute to go. Get ready, everybody. Get this move. Like I say, don't worry if you miss that initial move. We've got some levels set back as well.
What are you doing to combat that?
It's different in different places. Or
30 seconds to go. If it's going to be higher than 250.
And ride sharing, where 70% women
Good luck.
Half of them are moms. And that's because a lot of the job at Instacart is very different than just being in a car with strangers. It's about like going to the
And again, Scarlet Dollar as well that you can see is ranging, waiting for
really picking the right product
gold.
for the consumer. And we are seeing that being very appealing to women.
Oh. Oh, the drop. Wow, look at that drop on gold. Amazing. Well, the result came out. Okay, so it's better than expected. Drop.
World on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars. Only from Bloomberg.
What a drop. Look at that already.
Start exploring to see what's moving the markets.
Broke that level. Set.
Visit Bloomberg.com webinars.
Gonna keep the drop. That result. 4-7. That moves so quick. Go.
Futures up by 0.2% on the S&P, on the Nasdaq 100 up a little more than 0.1% at 8:30 Eastern time.
528. Way higher.
Here we go, and this is quite a surprise. Oh my, as Dick Enberg would say.
Go.
528,000 jobs created or restored, and interestingly enough,
Ooh.
that takes us
Let's just
back
pull
to
back.
where
That is
we were when the pandemic started. That level.
Odin.
Private payrolls 471,000.
Missed the sell because obviously it shot down before.
Up
East, as we know.
Unemployment
Nation.
falls to 3.5%. I'll look into the reasons for that. And the average hourly
Look at that.
earnings is interesting. It is up 0.5%. That's more than anticipated. So we go back up again after having fallen in the previous months to 5.2%. Labor force participation rate drops a tenth, 62.1%. The prior month, June, which was 372, now revised up to 398. So a very strong payrolls report for the month of July that belies everybody's thoughts. And I would imagine, John, you're seeing some movement in the bond market.
You think some big moves, Mike. Up 14 basis points to the front end on a 2-year.
Level.
The 10-year yield up about 8 to 9 basis points. 2s, 10s briefly. Negative 40 basis points. That's your bond market reaction. Guess where stocks are? The lower, down by 0.7% on the S&P.
I'm loading as many as I can because
1 full percentage point off the back of this. So yields up, stocks down, dollar stronger. Euro dollar negative 0.7%. 101.76 TK. Just wow. 528. We were looking for 250 in the previous number, close to 400k revised higher.
Amazing.
That's a big number, and this is a big move.
And the revisions are there as well. We're still waiting to get that data in. We'll get it here at any.
big miss as normal. 250, 528. Private was 7.1. So that's why we got in there and continued drop. Now let me eyes in, try and get the backs on it.
Why do we get this report so wrong?
In this case, you'd look at the contributing
Why?
data, the data points that tell you something about employment, and you try to figure out from there where it may end up. And you look at past history. The past history is that the July numbers have underperformed the forecast since 2017 until this year. And you have models in terms of what you know about various industries, and it's really hard. And it's now even harder given the fact that we're coming out
all the way from 1784 to 17.
What's going on.
With the
It's sat on this level.
Folks, to give you the real world here, I'm right now on the old HP12C, Lisa. I'm doing
a stochastic.
Moving average. The 3-month moving average with revisions is a small 437,000 jobs, Lisa, over the last 90 days. That is a wow statistic.
It is a labor market boom, and it's not just the headline number. Let's just go over some of these numbers. The average hourly earnings revised upward in the prior month, and it did not go down. It stayed at the same level of 5.2%, and it comes as the participation rate continues to fall. Mike, what do you make of this? How does this sort of signal the tightness or the looseness of a market that the Fed is trying to gauge out and hinging any pivot on?
Well, the funny thing is given the hiring levels, we saw a decline in the labor force of 63,000 jobs, and then gained 179,000 in the household survey.
1, 2, 3, 4,
while
7,
unemployment
8,
fell
9.
242,000. Interestingly,
And
in June we had seen a 353,000 number of people drop out of the labor force. So the labor force is continuing to shrink, which is why we're seeing the participation rate down. But 315,000 jobs in June were lost, according to the household survey. Now we get 179,000 back, and a big drop in unemployment. So those who are looking for work are finding work. And it looks like companies have not yet given up the ghost on hiring, even
Only
though
$200.
forecasts have been ugly.
Mike McKee, thank you. TK, that recession talk, for now at least, just got a
0.
freezing cold shower from that labour market report.
Coming.
Yes, I think that's true, and also it adjusts what we will see September 1. As you
Casting.
mentioned earlier, John, we've got other reports to
Bar is red.
that next meeting.
Up.
Let us get a briefing from someone who sat at the desk in the Eccles building. Randall Krosner continues with us, a former Fed governor at Booth School, Chicago. Randy, how does this change the calculus for the Federal Open Market Committee?
I think it's really clear that they are on a path to continue to raise those rates. Certainly 75 basis points will be on the table for the next meeting. The thing, it's not only the strength of the labor market, but it is also the significant increase in wages, higher than expected.
Just get that.
The Fed really worries about inflation expectation becoming entrenched. They're really hoping that inflation is going to be coming down below 5% fairly soon. But if people are still demanding 5% wage increases, that gets them into a lot of difficulty. And so that's why they're going to continue to move. I think this means that they'll certainly be in the 4s by early next year. And as I said before, I think it's going to be there for a while. And exactly as Jonathan had said, when the Fed moves the rates up, it's not that they just pivot and pull them back down. They typically keep them up for a while because they really want to stamp inflation expectations out of the system.
Randy, someone's got to ask this question. Does this pass the smell test for you, a number this big?
I mean, there can be always revisions. You never want to put too much emphasis on any one month, but you got an upward revision last month. You have a strong number this month. The Fed is not going to overreact to any one number, but
Fed will increase interest rates by 4.
That came last month with this will certainly embolden them to move expeditiously, as they have said. And I think they're going to get at least I think it's going to be very close to 4 by the end of the year.
By the end of the year, Randy, can you talk a little bit about the path? You did mention earlier that you expect them to go to 4% for the Fed funds rate and stay there for a while. How long is that while, and what will determine that length?
So it's going to depend a lot on these are statistics that we're getting. What's going to be happening in the labor market? What's going to be happening to wages? And right now we're not seeing the economy going over a cliff, and this is exactly the time that the Fed needs to be moving quickly. The economy hasn't sputtered yet, so they need to move, but also they haven't gotten the political pressure on them yet because the unemployment rate is at near record lows. So this is the time to be raising rates to try to stamp the inflation expectations and inflation out of the system.
Randy, you're going to throw me out of the classroom, but I'm going to ask the question. I'm going to raise my snarky arm and say, Professor Krosner, where's the neutral rate? And I say that with great respect, because within all the back and forth of all our guests and that, it's when does this become painful, which means through the neutral rate. Where's the neutral rate, Professor?
I always knew you were the troublemaker in the back of the class, and you continue to be. That's a very important question, and one where the consensus of the Fed, what they say is around 2.5, so roughly where they are. But that's 2.5 when they think of inflation being down at 2% in the long run. In the short run, when inflation is still very, very high, you still have a very dramatically negative inflation-adjusted rate.
Perfect.
2.5 is not neutral right now. In the long run, it might be neutral, but it's still quite expansionary when inflation is depending on your measures.
Are you giving up the Chicago school and joining Adam Posen with 3% inflation level? Is that really what we're talking about here? Is we need to adjust the
Each.
neutral rate higher?
No. I'm not saying that the goal should change from 2%, and I'm not saying that that in the long run they're not. I think they're right about or it seems reasonable that they are in a reasonable range for the long run. But in the short run, you can't say that 2.5% is neutral when inflation is 8%, and so you have a very significantly negative real rate. So there's sort of a long run versus short run kind of thing.
Hey, Randy, awesome to catch up. Randy Krosner there with the latest reaction to this payrolls report, and it really is a wow payrolls report. The headline number, 528K. The median estimate, 250. The previous number revised higher from 372 to 398. And everywhere you look, unemployment lower to 3.5%, down from 3.6. Average hourly earnings year over year, 5.2%. Month on month, 0.5%. Both of those better than expected. And this is how the market responds to it. Lisa said it. Good news. Bad news for stocks. We're down 0.7 on the S&P.
I thought we'd be down
on
much
the Nasdaq,
more, John.
we're down 0.9%. And Tom,
way much more.
Given what we're seeing in the bond market,
yeah,
I can imagine why you'd think that. Up 17 basis points on a 2-year, on a 10-year, up 10 or 11. That means 2's 10. The difference between the two, negative 41 basis points. Let me just get to FX, Tom.
Please.
Euro dollar down 0.6%. Some dollar strength out there now, 101.82. And I think the take from Connor Sen,
and
Bloomberg Opinion out on Twitter right now, is something we all need to think about. You don't go from 300 to 500K monthly prints to negative prints in 6 months. If you're worried about a job loss recession, you've got to kick that view to 2023. Now, Tom, if Connor's right, then I wonder what that means for how far Fed funds goes. And I'd throw in Larry Summers, which essentially is what Randy was talking about there. Larry Summers said on Wall Street Week with David Westin last week, the idea that we're at neutral with inflation where it is right now, and Tom, I'd add in where the labor market is right now. What did he say, Lisa? To be diplomatic, to be blunt, it was absurd?
Yeah, it was indefensible. That was the word he used.
Tom, I'd have to say this morning at least, it sounds absurd.
And I would suggest that Governor Krosner there was being delicate with his former public effort of being delicate about 2%, moving out to Posen's 3%, or maybe where Summers is, which is even a higher statistic. John, before we get to Jeff Rosenberg, we have to make the call of the summer, which is Priya Misra, TD Securities, as the curve inversion plunges beneath a negative 40 to a negative 43 basis points as well. I'm sorry, John, it's my call of the summer.
6 basis points deeper. Can
See gold now.
Another 6 or 7. Tom, I'm going to run.
More
I'm going to
buy.
catch up with Rick Reeder of BlackRock in the next hour. Mohammed Al-Arian.
You're leaving us?
Mike Collins of P. Jim. Anastasia Amoroso of iCapital. And we're here from the White House too. Secretary Walsh coming up, Tom. We said earlier on this morning, the story they've got to tell is getting just a little bit better. I imagine they'll lean a little bit more heavily towards the labour market report today and maybe away from the GDP report of the other week.
And futures negative 32 here now, a little bit of deterioration there in the last number of minutes. To make sense of this stunning report, Jeffrey Rosenberg joins us, portfolio manager of the Systematic Multi-Strategy Fund at BlackRock. Jeff Rosenberg, let me cut to the chase. How do you do multi-strategy with such a shock?
It is a bit of a surprise. Clearly, you guys have hit it on the head with good news being bad news, and it's surprisingly strong. And it's a reminder of just how strong the economy is. We're expecting an eventual slowdown, but it's not here yet. And Lisa and I were talking about this.
I knew your cable sets. This look.
On a big upside surprise. And so the narrative going in here from the FOMC was the Powell pivot, and this is the payroll pushback. And the pushback is they're not going to be able to pivot as aggressively as the market was expecting post that FOMC. And that's what you're seeing with that yield curve flattening and the big increase in the front end of the rates. Right. And then on risky assets and equities, they don't like that because they like
everything's
the
looking
end of the Fed tightening. And as Randy Krosner was talking about, if inflation doesn't come down, we are nowhere near neutral. And so you've got a lot more Fed hikes if you don't have that inflation coming down.
Jeff, I've got a bunch of dweeby bond questions for you, but I think it's important that a large population of our radio and TV audience worldwide don't have fancy financial degrees. And they're asking, what's wrong with generating 556,000 jobs with the revision? Why is so much good jobs formation a bad thing? I just don't get that.
Yeah, well, it's about overheating and it's about inflation. And one of the challenges that you have is in this report, you see a lot of signs of that wage inflation and the wage price spiral. That is really the bigger risk here. That you transition from COVID supply side disruptions, transitory, to something that's much more persistent. And the risk is that inflation hurts everyone, and if you don't snub it out early, the pain
15
that has
trade.
to happen later is much, much greater. And so that's why good news is bad news, because for financial markets, it means the Fed is going to have to do a lot more and is going to have to do that sooner. Tightening financial
Levels.
conditions to rein in the demand side is the
Watching
only tool they have to
still
address this
oversold.
inflation concern.
So, Jeff, we were talking before we got these numbers that the Powell pivot would turn into the payroll pushback, which is exactly what we're seeing. And that was your expectation just based on how lopsided the markets have gotten in their belief of the pivot. How much have we unwound of that? How much more do we have to go? And I say this as we look, yes, at NASDAQ futures down about 1% and going lower, but still well off the lows after surging over the past few weeks.
Well, there's a narrow reaction to today, and then there's a longer run issue. The narrow reaction is, as I looked at it last, about 17 basis points. You're taking back, a little bit less than 25 that you priced out following the FOMC and the Powell pivot. But the bigger issue is really what Randy's talking about and what Summers is talking about, that, to say that we're at neutral, we're at 2.5% is a conflation. It's the difference
What's to see
between the
stochastic
long run neutral, which is really what he was talking about,
here.
and the issue of the short run. And this is the issue we're going to be talking about for the next 6 to 9 months, which is we're past peak inflation. We're going to see inflation decline, but to what level? Because the forecast in the Fed to say that they're at neutral, as Randy was just saying, is that's a 2% inflation rate. If you don't get to that 2% inflation rate, say you get to a higher inflation rate of, say, 3%, well, what it means is that you're nowhere near your long-term neutral, and the whole bond market expectations in terms of where rates settle in have to reprice, because what we're pricing right now is a 2% inflation, a 2.5% long-term neutral, and that's all conditional on the realization of that 2% inflation rate.
Jeff, this is a sea of uncertainty, and we're getting little nodes that might point to a direction of travel. Where is your conviction right now as you tweak your portfolio, as you try to understand where the risks are mispriced in markets?
Yeah, we're a little bit skeptical of the rally that we've seen in risky assets. We're still concerned that you have both a shock in terms of inflation, what we're talking about here today in terms of what the Fed has to do in front of that, tightening financial conditions not being conducive for risky assets. So we've been pulling back from our risky asset position. We didn't add in the rally that we saw in July. It's important to recognize that when you're in bear markets, they don't go straight down. They have ratchets. They have bear market rallies. That's what most people are characterizing the last up move here. That's fairly consensus. We're a little concerned that we're in the consensus camp there, but we think all the data is pointing to still considerable challenges to the risky asset profile going forward here. So it's a little bit more cautious.
What about your portfolio of cash? I know that BlackRock has been adjusting its cash and holding a higher than usual level of it. How have you maneuvered in that space?
Yeah, every portfolio and portfolio management team runs, their own portfolios. In our fund, as Tom introduced at the beginning, we have run higher cash levels. It's a way to reduce some of the risky asset exposure. The other issue that all investors are facing in this summer environment is it's been an exceptionally illiquid environment, very expensive to trade. And so using cash as opposed to other means to bring your risk down is just a more efficient way of reducing transactions and retaining value for our investors.
What do you do on duration here? As a general statement at BlackRock, what do you do on duration? You guys are going to have 20 of you in a meeting. Yellen and Scream is going to assume. We just understand that. Probably Kostovich will be rude. I mean, that's just usually the way it is. But then Jeff Rosenberg, what's a duration call?
Well, I think the duration call, I'll speak for our team. Obviously, as you highlighted, there's a lot of different voices, and you're going to hear some more voices in Jonathan's program in the next hour. But it's still a cautious view on duration here. Again, that's the view of the uncertainty of inflation. Markets are pricing certainty. We're going to have a clean path to 2%. We are more skeptical about that being realized. And if it is not realized and you end up with higher inflation, the whole bond curve, inflation, risk premia, they need to reset higher. And so you got to be a bit more defensive on duration.
And we're not in any position.
Jeff Rosenberg, thank you so much. Greatly appreciate it right now. Lisa, let's sum this up, please, with futures negative 43, Dow futures negative 222, and the VIX 22.37.
Yeah, just to frame this, before this payrolls report, we were fluctuating between gains and losses, kind of meandering.
If you got any
the
thoughts,
reaction was so fierce and so quick.
Dude,
Honestly, it was very clear. And I've got to say that 1.4% decline right now, Tom, on the NASDAQ catches my attention. It is a repricing in equity markets to what bond markets are saying. Forget the dovish pivot. It isn't going to happen, not with numbers like these.
I haven't seen the standard deviation study yet, but I would think the Dow futures negative 220 would be negative 400, negative 500, negative 600, and we're certainly not there at this point. Again, the key number on the screen is that measurement of the difference of yield between the 2-year and the 10-year, and at negative 42 basis points. That is a jaw-dropping statistic. I did some very careful work earlier this week off the Bloomberg terminal, and the descent of the 2-year inversion, the speed of this movement of a 2-year yield higher than the 10-year harkens back to what we saw in the late 1970s. Ira Jersey knows that history, chief U.S. rate strategist at Bloomberg Intelligence. Ira, let's start with that first. If I take the vanilla spread, the 2s, 10s, its first and its second derivatives are absolutely stunning. What does that signal?
Yeah, it signals that we're probably going to go even more. And I agree with the sentiment that this payrolls report has to, has to readjust where all the front end yields in particular are going to go. The long-term yields don't necessarily have to move significantly higher than certainly not out of the ranges that they've been in so far this year, because at some point in the future we're going to have that recession that's going to be driven in part by the Fed and by a significant slowdown in both inflation and growth. So long end yields, 10-year yields maybe hover 3% plus or minus 20 basis points, but it's really that 2-year yield that probably has to go up a lot more. If we wind up getting to a 5% and the market prices for a 5% Fed funds rate at some point, then 2-year yields have to go up by still another 80 basis points, even after the big sell-off that we've had this morning.
Which really raises a question, Ira, about the yield curve inversion. Tom was talking about it. We've all been looking at it as we watch it go more and more negative to the lows not seen since 2000. How much, can you give us a historical perspective on this portending some sort of recession? Is there some sort of translation in terms of the depth of the inversion and the length and depth of recession?
So not necessarily. We got to the 2s, 10s curve, for example, in the late 1980s, got to around negative 60 basis points. And we had a
the best thing is to see the
recession about a year after that. So it doesn't necessarily have to be a particularly deep recession, but I think that the inversion in and of itself, is a signal that the market thinks that there's going to be a significant slowdown in the not too distant future. But keep in mind, we haven't been in a situation where, all of the slowdowns in the past have been driven in large part with inflation coming down. That's not the case now. So could we do? Tom mentioned, the 1970s.
Figure out this
exactly. Over 200 basis points back then. Now, I don't think interest rates are going to go that high, and we're going to see a 200 basis point inversion, but certainly a 60, 70, 75 basis point inversion is not out of the question.
And we'll do some work on that, folks, and that's some proportional analysis we've got to get to. Ira Jersey, I want to go to the optimist Neil Dudd of Renaissance Capital, who just wrote a blistering note talking about this unique report. And what's important in his math is the phrase, an inflationary boom. That can be level, Ira Jersey, but critically to me is the x-axis and the persistency of inflation across time. Is the x-axis going to be the key adjustment for the Fed, not the y-axis?
Well, I think
30
that's part of it. If you mean that, the
range
Federal
around,
Reserve is going to do the Mary Daly route, go the Mary Daly route, and hike to
boost
four and a
again
half,
the
5%, and then
open.
stay there
Stay
for a long
there.
period of time,
Yeah.
that's
Either
completely possible.
Well, but
When
Ira, I don't mean to
when-
interrupt, but Ira, this is absolutely critical. Is today's
Three level.
phrase, this is the stay there jobs report.
Well, I think it's heading there, and certainly we have another report similar to this, and I think that has to become the consensus, almost no doubt. Because when I look at this report and I
About
look at the
1784.
aggregate labor income figure, so basically everything taken, it's growing still at 9% year on year. Was 9.3% a month ago, but it's 9% year on year aggregate labor income growth means everyone is going to
Yes,
have
sir.
enough income in terms of to be able to continue to buy even amid higher prices. Now, will there be substitution effects because of what's going up? Yes, that will happen. But the point is that with the labor market this strong, that means that you can have much more persistent inflation for large portions of the economy, and that really has to worry the policymakers, and that's why they might have to keep interest rates higher than what the market's currently pricing. I think, quite frankly, the market has 2023 wrong, and I think that there's some opportunities there for people to trade around that right now.
Ira, if the market has 2023 wrong, where is it most wrong? Is it just on the front end, as we were saying, in terms of how much more people have to bring up their expectations for rate hiking? Or is it also on the long end, where there is a consensus right now baked into markets that that is safety, that the Fed will get inflation back down and that it will mean a lower growth trajectory ahead? Is that also in question as you talk about 4 or 5% Fed funds rates for a longer period of time?
Well, yeah, I think that it really is the front end, call it 5 years and in, that's still a little bit mispriced because we're still pricing for cuts in 2023. And I don't think those cuts necessarily will come, or if they do come, it's like at the very end after we've hiked to 5%. So I think that the long end, like I said, it doesn't have to move very much, but even a move from where we are now on the 10-year yield up to say 325 or 340, that's still going to be a 4 or 5% decline in the Treasury index, in that part of the Treasury index. So it still means a lot of pain for bond investors. So it's hard to love the bond market right here with inflation this high and with almost too much optimism on the path of inflation's decline.
Ira Jersey, thank you so much. Peter Bookfar just publishing over at Bleakley, and this is the economics of the moment. Noticing the bang-up jobs report amid GDP declining, and as Bookfar says, productivity is plunging. We get some productive comments right now from Michael Casper on the stock market equity strategist at Bloomberg Intelligence. Let me get this straight. Hugely employed America. I don't think there's a recession. Don't stocks go up? How are you and Gina Martin Adams going to recalibrate?
Not necessarily. So, as the previous two commentators said, this report is hugely inflationary, and we were really watching that average hourly earnings figure.
And up it went.
And up it went, and it got revised higher for the previous month. So really, it's hitting companies' margins, and we're also starting to see some demand destruction here, where revisions for revenues over the next few quarters are starting to be cut. So really not a great picture for stocks.
Michael, how much does this cut into profit margins versus from the free cash flow that companies have that are doing really well? When I say about this, I mean paying employees more at a time when they're starting to look to cut costs.
Yeah, so far, margin expectations for 3Q and 4Q are down about 40 basis points each. And the revenue cuts that I mentioned are about equal size. So you're seeing 3Q EPS estimates go down about 422 basis points, 4Q down about 322 basis points, and then fiscal year 2023 is also down about 3 percentage points over the last 9 weeks, which is the largest cut we've seen over the same time frame since we started recording this data back to 2010.
Michael, Tom was saying he was looking at the indexes, in particular the Dow, as he is wont to do, and saying he's surprised that it wasn't down more. And it's a valid point considering the repricing we're seeing on the front of the yield curve. How much is this because of the resilience that we've seen in earnings versus perhaps misplaced optimism, as some people have called it?
I think a lot of it is the misplaced optimism, right? So people expected inflation to start coming down a little bit, and maybe some signs for the Federal Reserve to maybe start easing in 2023, or at least take a pause. But inflation just keeps on chugging. So you've got to really bake in kind of where the Fed's going, and it just seems to be the rates picture is going higher, higher, and higher.
This has been great. Way too short a visit. Michael, come back after you guys rebrief and recalibrate over the weekend. It's going to be something. Michael Casper here with Bloomberg Intelligence. Alan Ruskin with a blistering short paragraph. Lisa, as everybody comes into the Bloomberg terminal with opinion, the wonderful analyst at Deutsche Bank, a million miles from recession, Lisa, Ruskin says positive for the U.S. dollar.
It is positive for the U.S. dollar because it means more action by the Federal Reserve, and it means strength. And strength should be a good thing, but right now it is a difficult one for the Fed to swallow, considering that they're dealing with 9.1% headline inflation. Pair this with an upside surprise to CPI next week, and then what happens?
30 minutes to go.
DXY up a full stick back to a 107 rounded up level, not new highs on strength, dollar strength, but there it is in the equity market. Futures negative 42, Dow futures negative 213. A bit of a wait. The VIX out an exact stick, 22.44. A stunning report, and of course, coming up, he'll have something constructive to say. The Secretary of Labor, Martin Walsh, with our John Farrow. This is Bloomberg. Stay with us.
Well, where did that come from? A monster upside surprise this morning. Good morning, good morning. Equity futures down because apparently good news is bad news for this equity market. The countdown to the open starts right now.
And that's what I told you. I said they were saying good news is going to be bad news.
For the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
Live from New York, we begin with the big issue. The Fed has a lot more work to do.
Jobs report is quite key.
What Chair Powell told us is, well, he's data dependent.
It's really clear that they are on a path to continue to raise those rates.
With this jobs report and the inflation number due next week,
Certainly 75 basis points will be on the table.
That's why these data points coming up are so crucial.
A hugely important number in today's jobs report.
It's not only the strength of the labor market,
Labor force participation.
The key to bring out here,
the significant increase in wages.
A lot of answers we still need.
Payroll today.
How the economy is going to react.
The Federal Reserve still has its work cut out for them.
Joining us now is Mike McKee. Mike McKee, what a number.
What a number. It took us all by surprise. Wall Street was leaning weak, but we got extraordinarily strong. More than twice as many jobs were created and restored than the consensus forecast had called for. 528,000 jobs in the month of July. June revised up to 398, a total for June and May of 28,000. The unemployment rate falls to 3.5%. That matches the low before the pandemic. Participation rate, though, falls to 62.1 as more people leave the labor force. Average hourly earnings stay the same at 5.2%. Does the Fed read that as inflationary or not? We'll see. The jobless story is interesting. This unemployment rate at 3.5%. The U6 rate only at 6.7%, unchanged from the month before. Discouraged workers apparently not finding more jobs. It's kind of hard to parse that out at the moment. But as I mentioned, labor force falls, employment rises by 179,000. And of that,
That was a nice sell.
Establishment survey, 401,000 in the service industries. Unemployment down by 242,000 in that household survey. And John, we are now by 32,000 jobs above where we were when the pandemic started. We have regained all of the jobs that we lost and 32,000 additional jobs. We'll see if that keeps going when things get revised next month. But the green line there, I want to point out, if we had kept adding jobs at the pace we were before the pandemic, that's where we'd be. So you could argue that we're still short of where we want to be in terms of job creation.
Mike, did we just bury the recession talk, at least for the next month?
Yeah. There's no way you can get a recession when you have a 3.5% unemployment rate and you're adding jobs at the pace that we are. It does feed into this debate, the Summers and Fed debate over whether or not you can bring down unemployment or bring down the vacancy rate without raising unemployment. Vacancy rate dropped in June, and look what happened to the unemployment rate.
Mike McKee, looking forward to the coverage through today. Mike McKee there on the payrolls report, a blowout payrolls report. Off the back of it, futures lower down 1%. Because yields are higher by about 17 basis points on a 2-year to 3.2%. We're going to get a ton of research on the screen for you, a ton of reaction as well. This came from Neil Dutta of Renaissance Macro. A significant beat in payrolls with an even more surprising downtick in the unemployment rate. Recession talk is premature, along with talk of a policy pivot. This report is consistent with an inflationary boom, he says, 75 in September and on the table in November and December for this Fed. Joining us now, Mohammed Al-Erin of Bloomberg Opinion and Queen's College, Cambridge. Mohammed,
a recession in the US. A recession.
Number from 33 minutes ago.
Maybe in the UK, but
as Mike said, a very strong report. I like it, except for the declining labor force participation. What does it mean? Think of the economy, policy, and markets. Really good news for the economy. The most important part of the economy is going strong, and that will be celebrated at the White House, and rightly so. Go a few blocks to the Fed on the policy side, and they are not going to welcome this report. It's bad news for them in every single way. It makes the notion that we are at neutral comical. It means that they're going to have to go even more. And the markets, you saw from what happened to the inversion of the 2s10s, it's now beyond 40 basis point, is saying that they're going to have to somehow break this economy to bring inflation under control. And for markets, as much as we've seen stocks come back, it is interesting that the 2-year now is all the way back at 320. So we've retraced, John, 35 basis points in the last week. And stocks are pretty robust. So the technicals are still favoring stocks right now, despite what you see on the screen.
Mohammed, it's a massive move. Larry Summers last week, after those comments from Fed Chair Jay Powell, said this to David Weston on Wall Street Week. Jay Powell said things that, to be blunt, were analytically indefensible. You also wrote an opinion column on it, and you talked about where we were in this range of neutral. You said, quote, as to the general neighborhood for that level, I have a hunch, but I'm far from certain that we are still below it. Is your hunch? Mohammed, those comments from Chair Powell in that news conference, you've mentioned how ridiculous they look now. How on earth can we be neutral?
17, 74, possibly a pullback to.
We cannot, and that was an
Pullback.
unscripted comment. It didn't go well with other things that were scripted, including his comment on the neutral unemployment rate, including all other comments. So this was unscripted, off the cuff, and we've had 4 or 5, I've lost count, federal officials this week walk it back. We're not at neutral. The Fed is going to have to do more, and hopefully it won't break the economy as it tries to catch up. It should have started, as you know, John, we've talked about this for over a year. It should have started much earlier, and now it's having to catch up frantically. And no one likes to see a central bank catching up frantically.
When you say more, can we put some numbers on more? 75 in September. What is more, Mohammed?
I think that's the bigger one. I think now,
so if we get
side, downside.
With things being where we are today, and that's a big if. Yeah, 75 basis points would signal the possibility of another 75 basis points. That's what you would see. Now, things are fluid. A lot can happen between now and September, but this number is not going to be welcome. This report is not going to be welcomed at the Fed. This is bad news for the Fed's credibility.
Bad news for them, and they're going to go again, and maybe again and again. And Mohammed, I think we've got to think about how long we stay up there at that peak Fed funds rate as well, because Alan Ruskin of Deutsche Bank put out some research in the last month or so, and he said in the last 3 Fed tightening cycles, the time spent at peak was 7 months in 2000, 12 months in 06-07, 6 months in 2018-19. Mohammed, are you giving a bit more thought to that? That once this Fed is done and gets to that peak rate, how long they're going to have to stay there?
So the 5.2% wage number is really important. Think of the dynamics of inflation. Phase 1 was energy and food. Phase 2 was broadening of energy and food into other components of core. But wages were well behaved, quote unquote. Weren't well behaved for the average worker because it meant negative real wage growth. Now we're seeing wages pick up, and with an unemployment rate down to 3.5%, a labor force participation coming down, jobs being created at over 400,000 on the 3-month moving average, you would expect wage rates to go even higher, not just 5.2% growth, but higher. So the next phase of inflation is going to be wage driven. If that occurs, it's good for the worker, it's good for the economy. However, it means that core inflation will prove to be much stickier coming down. So I do think that markets are a little bit premature in thinking that the Fed is going to start cutting rates aggressively early in 2023. It's going to take longer than that.
You're not alone. We've had a lot of banks come out with a lot of notes pushing back against a lot of this rally. Bank of America said take profit on the bear rally. HSBC said it's time to ditch.
White House,
Goldman said
economy,
stocks could
and
fall
news.
without a shift in the macro data. I wouldn't call this a shift. It's a shift in the right way. Barclays said the emerging Goldilocks narrative feels misplaced. This data would speak to that. Mohammed, I think it was HSBC again, Max Kettner, who said it was wishful thinking. We've had a massive rally, Mohammed, off the lows of November, or rather the lows of June. June 16th, we've had a move of about 20%. Mohammed, when you think about that, how much more weight we've added to the equity market rally in recent weeks, what would you be doing with stocks right now?
So first, what's happened isn't about fundamentals. I've stressed that. It's about technicals and it's about relative valuations. The technicals still favor the stock market. That's why the stock market has been so resilient to what has happened to rates over the last few days. Remember, there's a lot of money sloshing around the system. We've put a ton of liquidity in through all these central bank QE injections. Relative value. People are really stuck, John. They don't know where else to go. So stocks look like the best of, rather, a list of evils, if you like. So you got to respect the technicals, but on a fundamental basis, yeah, stocks shouldn't be where they are. But never underestimate the technicals. The technicals have to play out. We'll see whether the sorts of moves we're seeing today are going to shake some people out, but the technicals have proved to be very, very strong.
Mohammed, 210's at negative 42, pushing negative 43. What does that tell you?
It tells you that the market thinks the Fed is going to make yet another policy mistake, that they're going to end up by over-tightening because they've been so late. Remember the phrase, time, skill, and luck. That is what a central bank needs. It doesn't have time. It fell behind and it lost that. So it needs a lot more skill and a lot more luck. And the marketplace is saying, you know what? I don't think you're going to have enough luck and skill to avoid an over-tightening that pushes ultimately the economy into recession. The economy is not in recession now. The economy is doing well now. But people are worried as the Fed catches up to reality.
Got a 20 basis point move on a 3-year right now, up 19 on 2s to 324. Let's round that up for you. Mohammed, you're going to stay with us, I'm pleased to say. We're going to get Rick Reader at BlackRock on the phone to weigh in on some of this as well. Equity market futures, we are down by more than 1% on the S&P. On the Nasdaq, we're down about 1.5% right now. Want to get you a flavour of some single names, some movers. Here's Abby.
John, well, we are certainly down, as you were just mentioning, by about 1% on the major averages. Not surprisingly, it has everything to do with that super hot jobs report and the idea that the Fed will have to continue to hike aggressively. That, of course, is weighing on big tech the most. Apple down 1.5%, Microsoft down about the same amount, on the idea that these stocks' evaluation is going to look more expensive as rates yields rise. Chevron, the energy complex, down too. This is oil is now sharply below support of its 200-day moving average. Oil below around $87 per barrel. And then the banks, which you would think would be helped out by rates rising, are down just a little bit. And that has everything to do with that yield curve that you and Mohammed were just talking about. At this point, inverted the most since August of 2000. And this market, this equity market, John, certainly feels like that long, slow bear market.
Abby, thank you. Coming up, DC, get some good news.
It's surprisingly strong, and it's a reminder of just, how strong the economy is. We're expecting an eventual slowdown, but it's not here yet.
We'll head down to Washington up next, and we'll continue.
This is Mark, and this is a car, a sofa, a bag. But since Mark has been trading with Capital.com, he sees a brand, he sees value, he sees an investment. Start seeing the world differently with Capital.com.
Continue the conversation with Mohammed and get Rick Reader at BlackRock on the phone. That's next. This is Bloomberg.
record-setting temperatures, deadly forest fires, receding rivers. In this episode of Bloomberg Green, we're focusing on extreme weather. We'll explore the
Watching
science
gold, we're
behind
ready.
the recent heat wave.
It's going to get more
Good.
extreme than it is now. I'm afraid that's inevitable.
The consequences of extreme weather.
There is overall low awareness that heat kills. And until recently, there's not been as much effort to try and educate people about the dangers of heat.
And solutions for the planet to mitigate and adapt.
We need government to lead on this, and we need government to stimulate, regulate, and stop certain things happening.
I'm Kaylee Lyons from Bloomberg's global headquarters in New York, and don't miss this week's edition of Bloomberg Green, airing this weekend on Bloomberg TV, Quick Take, and online. Bloomberg Green, bringing you the business, data, and innovators fighting climate change. Reinventing climate news on TV, Quick Take, and Bloomberg.com.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles.
One of the most important things is looking around the corner.
Look for Chief Future Officer on Bloomberg.
It's surprisingly strong, and it's a reminder of just, how strong the economy is. We're expecting an eventual slowdown, but it's not here yet. The narrative going in here from the FOMC was the Powell pivot, and this is the payroll pushback. And the pushback is they're not going to be able to pivot as aggressively as the market was expecting.
Some good news for Washington, D.C. A blowout, upside surprise payrolls report pushing back against mounting recession talk as the Biden administration inches closer to passing a key piece of its domestic agenda. For more down in D.C., let's get to Anne-Marie. AMH, that is a monster number.
It is a monster number, and as Mohamed El-Erian just told you, Jonathan, it's going to be welcome news at the White House, maybe not so down the block at the Treasury or the Fed. But for a president that has been very suffering in the polls, the economy is the number one concern for the electorate because of inflation. This just goes to show the economy is strong and healthy. How do you call this a recession when the unemployment rate is at 3.5%? Not only has the administration will claim, not only has they recouped all the jobs lost during COVID-19 pandemic, but they also added 32,000 more on top of that. That is going to be the message for the next 24 hours.
Anne-Marie, thank you. And in the next 10 minutes as well, in about 15 minutes, we'll catch up with Secretary Walsh from outside the White House. Joining us now on the phone is Rick Reeder of BlackRock. Rick, what a monster number. Your thoughts on this one?
Pretty incredible, Jonathan. I mean, you can't, no matter how you parse it, it is consistently strong. I mean, across the board. I mean, stunningly strong. What's amazing about this number is it's incongruent with the claims data that showed some softening, the JOLTS data which shows openings slowing, the surveys you're seeing in the ISMs and otherwise. And by the way, companies, one after another, the Walmarts, the Amazons, the big employers, talking about layoffs and certainly slowing down hiring. So it's an impressive number, and it's surprisingly so.
Rick, are you changing your thoughts about how much work the Fed needs to do? We talked a number of months ago, and you said maybe some weakness starts to come in the labor market. We don't see it yet. What are your thoughts on that now?
John, that's exactly right. I mean, you have to assume that the Fed's going to do 75 in September now. I think that's got to be your base case. And then, while the economy's moderating in a number of places, you're seeing it, certainly in housing, certain parts of the industrial complex, you're seeing it, retailing, you're certainly seeing it. But, you're not, I mean, the people, it's certainly not, when you've got a 3.5% unemployment, pretty strong. And so I think you have to assume that the Fed's got more work to do before slowing it down. I mean, the markets have been pricing in a flip to the Fed easing aggressively, which quite frankly was hard to believe, was presumptuous to say the least. But now you have to assume that they're going to go 75, draining liquidity as well. And so you have to build that into your asset allocation matrix for sure.
Let's build that in right now. You've talked recently about putting a little bit more cash to work. You've had that dry powder through much of this year. Rick, how have you been using the recent strength both in equities and in credit too?
Yeah, so, it's funny. We've been letting the line out a bit, as you said, Jonathan, across risk assets, but the place we feel by far the most comfortable is in the credit markets.
Back in a minute. Ready for the open.
The fear recession or growth slowdown, your interest coverage is still great at companies, and you've priced the bond market, the credit market has priced quote unquote recession much more aggressively than the equity market has, and you're getting paid for it, whereas defaults are actually going to be quite moderate. So we've definitely been adding in credit. We talked about last month on your show, still like it. And actually, quite frankly, hopefully you see some pressure here on spreads, because I do think the credit markets are attractive. You're getting yield now in the portfolios that are pretty generous that we haven't seen in a really long time. And you have to assume the Fed's going to continue to tighten financial conditions, but credit markets are a place you're getting paid for it. Other markets, I think you got to be a bit careful about risk, given the Fed's disposition from here.
When you say other markets, do you mean stocks?
It is. And I tell you, I heard Mohammed describe it. I think he's exactly right. The technicals have been impressive. You get some stock buybacks, and you get the technicals, meaning people aren't long, haven't been long, and the equity market just sort of floats higher into that. And I think it's, I think the stock market's okay. I don't think it's terribly rich, but given you've got an uncertain set of economic conditions, this number notwithstanding, you've got a Fed that wants to tighten financial conditions. It's just okay. And I'd rather take my risk, get carry into our portfolios, get interest income in the portfolios more aggressively than taking a lot of beta risk.
Hey, Rick, awesome to catch up. Thanks for jumping on the phone. What a report. Rick Reeder there of BlackRock. Mohammed waiting patiently for us. Mohammed, thank you for that. Rick talked about it, the tightening in credit spreads. We've had 140 basis points of tightening in a single month. We've had a 20% move on equities, Mohammed, on the NASDAQ going back to the middle of June. That's an easing of financial conditions, Mohammed. And when we talk about the Fed needing to do more work with Fed funds, what do they need to do with financial conditions?
They need to tighten financial conditions. And as you point out, it's been going the other way. And part of that has been due to their commentary. We've had failures in not just analysis and forecasting, but also in communication. John, the other thing I would keep an eye on, and we haven't talked about, is what does it mean for the rest of the world? The dollar is strengthening again. That's not good news for the rest of the world. And for those who are very tempted to fade the US and favor other parts of the world, this is going to be a warning to them. I think the US remains, in relative terms, the strongest economy and the most attractive markets right now.
Mohammed, yesterday you congratulated the Bank of England for being what you said was honest, transparent, open. They're forecasting a recession that starts at the end of this year, inflation that runs maybe peaks at 13%, perhaps more, and the story's sticky into 2023 too. What would you like to hear from this Fed? And Mohammed, do you think they have the luxury of being as open, as transparent as Governor Bailey has been?
So they need to do something. John, you quoted Larry Summers. You could have also quoted former Fed officials that have called Fed projections laughable, dreamy, fairy tale. Look, the Fed has to restore its credibility. It has to be seen as the trusted advisor that puts out their honest, non-political projections. That is absolutely critical. You need that in a system. That's why you give central banks political independence, for them to be technocrats, not to be politicians, to be technocrats. Go to the Bank of England, and Governor Bailey's being unfairly criticized today for being dead honest. It's not easy for a central bank governor to say inflation is going to go up to over 13%. We may fall into recession in the fourth quarter, and it will last most of next year, and the balance of risk is on the downside. That is a really difficult message to give. No one wants to give that message. And yet, Governor Bailey had the courage to do it. The Bank of England had the courage to do it. And I think it's important, because what does it do? It acts as a catalyst for let's get policy reaction so that we don't end there. Okay? He's saying, given the current policy configuration, that's where we're going, because you hope you're going to trigger a policy reaction, because people say, I don't want to go there, and you'll get the proper policy responses. And that's why it's really important to have a technocratic central bank.
Mohammed, I want to take this a little bit longer, so I'm going to ask the control room to blow this break and take this at least for another 3 or 4 minutes. It's a long, long road to September and the next Fed meeting. The next Fed meeting is September 21. Next week, we get a CPI print. In early September, we've got another jobs report. Then I think we've got another CPI print on September 13th, August 10th next week, September 13th, the next one. That's a long road, Mohammed. Are you expecting any of this to change before then?
So I'm hoping that headline CPI is going to come down. I'm hoping that core CPI doesn't go up. That's the one I'm really worried about. I'm worried about core. I'm less worried about headline. I think we're going to see the 9.1 come down. I hope the economy remains solid. You know, I hope somehow we can get control of inflation without undue damage to the economy. That's not, unfortunately, my baseline, but there is a possibility. But as you say, we're going to find out a lot, and Jackson Hole is going to be important because that's going to update us from a strategic perspective as to what the Fed and what Chair Powell in particular is thinking at this stage.
Mohammed, the balance sheet hasn't had enough.
Don't get laser eye surgery before watching this. LASIK Eyes has put together.
The balance sheet hasn't had enough discussion for me. QT's kind of taken a back seat in a way that it didn't.
And we're back. Coffee topped up. Time, we've got 5 minutes to the open. See if we can get our final trades of the day, the week. Really good week.
It's critical for the Fed to update.
Through scalping mission.
We are still stuck with a framework that's calibrated for an economy with insufficient aggregate demand.
Empty.
We don't
All
have
back to some
insufficient aggregate demand. We have insufficient
distance.
aggregate supply. So the Fed should be looking at its framework and rethinking its framework, even though it's just over a year old. And in that context, it has to think not just about rates, but also
See what
about
we can get on.
You mentioned the rest of the world, Mohammed, and maybe let's finish there. Where do you think this leaves the global economy and the risk elsewhere, particularly in emerging markets, with the Fed that's going to have to be much more aggressive in your mind than many people are anticipating and potentially stay there for quite a while?
We've done 9
Yeah, it's going to
trades
test the
today.
resilience of the rest of the world. You know, stronger dollar, higher rates is not something that developing countries welcome. It complicates their lives because it means higher imported inflation. It means that capital markets become less predictable. So we are going to test the resilience. Worry in particular about the most vulnerable developing countries.
Mohammed, awesome to catch up. I know you've got to jump on another call, and we appreciate your time this morning.
We do.
What a move we've seen, and what a jobs report as well. Mohammed, a great friend of this program, of course. With
4 minutes to go.
Yields higher by, let's call it 20 basis points on a 2-year. We can round this up to 324. It's just a massive move. What Mohammed said about 20 minutes ago. The Fed is going to have to break the economy to bring down inflation. The Fed is going to have to break the economy to bring down inflation. That's Mohammed's view. In a moment, we'll get the view of Anastasia Amoroso of iCapital. We'll get the view of Mike Collins of PGIM. And we'll get the view of this White House. Secretary Walsh just around the corner for his view on this report and a little bit more good news. In fact, I'd say a little bit more and some in this jobs report for this White House. Futures down on the S&P by a little more than 1%. Yields higher by 20 basis points on a 2-year. And this curve inversion, 2s 40s, 2s 10s, now negative 40 basis points. Big news this morning. This is Bloomberg.
Green dot. Thanks. Look, everybody. Week.
We were thinking big from the beginning. I mean, the reason that I was interested in doing this in the first place was a much bigger challenge than
1 minute, 20 seconds to go, everybody. Good luck. See, if you're going to trade, 30.
There was a big leadership opportunity. We looked around at an industry where there was 20 billion pairs of sneakers made every single year, and it was 100% made from
Trade.
plastic and the hides from cows, and it was terrible for the environment. And we thought that we could offer something to consumers that was differentiated in the way it feels, more comfortable, higher performance, and do that because we use sustainable materials. And in doing so, we could take a really interesting leadership opportunity and grab that and use that to
40
tell
seconds to
a totally
go.
different story,
Logged in.
a totally different vector than what the rest in the industry were doing.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already
20 seconds.
To catch up,
This is Bloomberg Wall Street Week. I'm David Weston.
we've got the information and insights
David, you just hit the nail right on the head.
from business's most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres tonight with replays all weekend on Bloomberg Television and Radio.
Go. Good luck.
Innovation, money, and power collide in Silicon Valley and beyond. Bloomberg Technology with Emily Chang. Weekdays at 5 p.m. in New York and 2 p.m. in San Francisco.
Here's a number for you, 528,000. We were looking for
Down.
250k. That's what we call a monster upside surprise. That means futures are down. They're lower by 1% on the S&P 500, on the Nasdaq down by 1.6%, and I hate it. I hate it when good news is so-called bad news. And here's the why. Switch to the board and get to the bond market. There's your opening bout for equities. Yields higher, aggressively so, by 13 basis points to 282 on a 10-year, much more so on a 2-year, up by around about 20 basis points on a 2-year yield.
Green
this
dot.
morning. Unbelievable. In the FX market, yields up, dollar stronger, euro down, euro dollar down to 101.55, negative 0.9%, and crude, get used to not sub 100, sub 90 apparently. $87 and about 15 cents. We're down by 1.6%. That's a cross-asset price action. About 30 seconds into this one. Let's get you some movers. Here's Abby.
John, well, sticking with that good news is bad news macro theme, it's all about big tech weighing on the markets today because, of course, as yields surge higher on that monster jobs report, that pressures big tech valuation. Apple down 1.3%, Microsoft down 1.1%, NVIDIA, the chip maker, the chip giant, down 1.8%. So we have some real weakness for this tech sector. We also, interestingly, have weakness for the banks, the financials, not in a huge way. Bank of America down 0.3%. This, of course, as yields surge, but the yield curve, as you've been mentioning, inverted by more than 40 basis points at 210, the most since August of 2000, John, and it's hard to not remember that bear market then, where there were lots of rallies and then drop, rally, drop for a long period of time. It almost feels that way again. But today, of course, we do have some weakness on that monster jobs report.
Abby, thank you. Ian Shepherdson of Pantheon Macroeconomics out on Twitter right now. How's that recession call going? I'd say not well this morning. Equities are down about 1% on the S&P. On the Nasdaq, we're down by 1.2. Big tech under pressure. Taking a look at that. Here's Taylor Riggs.
And John, the numbers, of course, through yesterday's close, when you think about sort of the big rally that has been underway from the low that we had June 16 up until now, up more than 19%. We'll, of course, subtract a point from that this morning when you think about sort of the big rebound that we had. Okay, 17.8%. So not sort of quite out of that bear rally, but sort of clawing our way out of that. When you take a look at maybe some of the individual sectors, or if we go sort of out of sort of the NASDAQ,
Brilliant.
you can see ours,
Yes.
of course,
Oh,
yesterday, 37%.
fantastic. Just gotta wait.
Stocks index, of
Wait,
course,
so we got
biotech
1,
already
2,
sort of climbed
3,
its way out
4,
from the big
5,
lows, up more than
6,
20%.
7.
As you know, though, it always comes down to not only the big jobs report today, the CPI next Wednesday, and the pivot from the Federal Reserve, or maybe no more pivot. If we're thinking, are we still dovish? Are we now going to be hiking 75, maybe 100? It all comes down to the earnings outlook, and that's what we're looking at as well here. When you think about big tech, the rate story is, you know, sort of the input into that
1,
discount
2,
cash flow
3,
model is all about rates, and of course looking out for a bottoming out of some of the earnings revisions, lowers as well to
buys.
signal out a bottoming of this market.
Taylor Riggs, thank you. The Fed has more work to do, and that means maybe we've got some more
Open.
wood to chop on the Nasdaq. We're down about 1.4% on the Nasdaq right now. Bank of America publishing moments ago.
20,
we now
20,
look for the Fed's
24.
target range of the Fed funds rate to 350 to 375 by year
£200,
You'll hear
about
the floor a
200.
lot more going into CPI next week, and we'll see whatever CPI is. Right now, then, down 0.9 on the S&P, on the Nasdaq down by about 1.26%. We reverse the recovery rally with yields absolutely surging. Good news turning into bad news for markets. A monster upside payroll surprise, fueling bets for another big rate hike. Kaylee Lyons has more. Hey, Kaylee.
Hey, John. Well, that's reflected in the cross-asset price action.
Well, there's our first
down, but the dollar
stop, as
stronger on
you
the
see.
day. And as you said, Treasury yields are absolutely
I'll have
flying, more so on the short end, which of course is the pricing of more aggressive Federal Reserve
3,000.
rate hiking. The 2-year yield right now on the day up 18 basis points to just shy of 323. And of course, that puts it even
Even
more
in-
ahead of the 10-year yield. Right now, that curve inverted by more than 40 basis points. That is the deepest inversion going back 22
They just sit in
years
your hands,
August
wait,
of
with
2020.
green dots.
Usually that is an indicator of a recession, though as you've alluded to, this doesn't look all too recessionary at the moment as the market is pricing in a greater
Yeah.
odds of a 75 basis point hike next month, John.
Kaylee Lyons, thank you. Thank you very much. Just breaking down some of the data and what this all means for the Fed. I'll break you down on what's going on in this market right now. About 4 minutes into this session, equities are lower by about 0.8% on the S&P 500. On the Nasdaq right now, we are down by about 1.15%. I'll give you the sector breakdown as well on the S&P 500. You can work out where things might be going given what's happening with yields now, up by about 20 basis points on a 2-year. Information technology down by 1.2%. I want to run you through the bond market as well. 2s, 10s and 30s shaping up as follows on a 2-year yield, up by 19 basis points on a 2-year to about
Green on the
323.
trend bar
On a
as
10-year
well.
at the moment, yields higher by 13 basis points. So the heavy lifting happening at the front end of the curve. That means the curve inversion, 2s versus 10s. Now negative 40 basis points, and Tom Keene
Hold
and
on,
myself
buddy, on that.
this morning said the same thing. A shout out to Priya Misra of TD, who was looking for this. Just a monster call from her. She said negative 40 basis points on 2s, 10s. Right now this morning on 2s, 10s, we have negative 40 basis points. On Bloomberg TV and radio, I'm pleased to say that joining us now is Labour Secretary Marty Walsh off the back of this stellar jobs report. Secretary Walsh, the floor is yours, sir.
Wait.
Your thoughts on this one?
Second green
Thank you very
dot.
much. This certainly is a great jobs report. When you look at the different sectors,
You see our
most of the economy
things
is recovered. The jobs that were that
Hey.
companies had pre-pandemic are all
Gastic
returned,
is
so
hot.
it shows good gains. We've showed some good wage growth. We've shown good areas. Manufacturing is one of those areas that certainly we've seen come back, not just come back to pre-pandemic levels, but go beyond that. I think with the
W
CHIPS bill
pattern
that was passed
again.
and
I
signed,
drew
signed
out
into law
that
next week,
W.
we can do more manufacturing in the United States
They
of
would
America,
hit
which
this.
in the long term will help us with some of the inflationary pressures such as semiconductors and more microchips.
Secretary Walsh,
Nice
what
to
a
be wrong.
turnaround this has been since the pandemic. Can we just take a moment to think about that, how much we've recovered over the last couple of years? And can you talk to me about how sustainable you think these jobs gains might be?
Well, I'll tell you, pandemic, March of 2020, I was the mayor of Boston, and we were shutting businesses down. We were shutting restaurants down. We didn't really know what the economy held. And thinking about where we are today was really incredible. And I think that this will, in my opinion, will be sustainable moving forward. I think companies are understanding. I think we're going to have a new type of economy. I think we're still obviously dealing with inflationary pressures. You talked about it right before we got on the air here. I heard you talking, and I think that, you know, we're going to adapt and adjust, and we're going to move forward. I think that the infrastructure law that was signed into law, we're going to see more investments all across America on roads and bridges. I think with the CHIPS bill that was passed and move forward, we're going to see more investment in manufacturing. Hopefully, the bill that's being worked on now in front of the Senate is going to be working on prescription drug costs and environmental climate change and some other areas is going to help. When you really think about a lot of what's happened here under the Biden administration is something that we've talked about for the last decade or so. And these are all going to be good bills and good investments to move our economy and, quite honestly, move America forward.
I know you've got a lot of people to talk to this morning. I did want to talk to you about the negotiations on the West Coast with the ports. This
I was
your
gonna bring it
quote.
up.
I know you are, because this was your quote last time we spoke. You said, next month if I come on this show, if we don't have a contract and we're not close to a contract, then you and I might be having a very different conversation. So I guess, do we have one? Are we close to one? Or are we having a very different conversations?
No, we're not. I don't know how close we are to getting a contract, but one thing that has happened since we've spoken and both sides have agreed is the healthcare, and that was a big sticking point. That's usually a big sticking point, the costs around healthcare and who's going to pay for healthcare, and that was negotiated and solved about 10 days ago. So I'm very pleased with that. Now they're on to the next phase of negotiation. And usually when you think about contracts negotiation, the biggest sticking point is around healthcare, pensions, things like that. And those are in the rearview mirror now. Now they're moving forward on some of the other issues they want to tackle. So I feel good where we are. If I said that, I probably should have used my words a little better if we don't have a contract by next month. But I am very confident where we are in the negotiation right now. I am not concerned. And I stay in very close contact with both the longshoremen union and the companies on the ports to offer any type of support we need. But every time I talk to them, they say we're moving forward.
Secretary Walsh, for some people who might not be that confident as you are, they might not be familiar with how this works, with this particular set of negotiations. As you said before, this particular one's a little bit different because it only starts 6 weeks before expiration. Can you help us understand things a little bit better by comparing it to 2014, where we were then at this stage and where we are now?
Well, I think we're further along than we were in 2014. If I remember, that took an awful long time to get done. But just for people that don't quite understand collective bargaining or negotiations, usually you can start months ahead of time to lay down the foundation for a contract. In this particular case, it's 6 weeks before the termination of the contract, which means it always runs over the expiration date. I don't think they've ever had a contract done on the expiration date itself. Normally you want to shoot to get a contract by expiration date. But what both sides have agreed to do in this case have continued to agree to keep the current collective bargaining agreement in place while they negotiate moving forward. There's been no conversation of strikes, lockouts, slowdowns, none of that stuff. That hasn't even broached or brought up and talked about. And that's the thing that I don't think will happen in this negotiation. And I'm going to continue to talk to the sides, and where I need to put pressure on them. Certainly this is a big issue for the ports and for products coming into the United States of America, and quite honestly for exports out of the United States of America too. So we want to stay very close to that. Myself and General Lyons, who's the liaison at the White House, has been in constant communication. We talk a couple times a week, but we have a scheduled call just to go over where we are, just so we can stay on top of these negotiations.
Secretary Walsh, a monster jobs report is the final question from me for Boston. Do we need to see some Labour turnover at the Red Sox?
Oh, God, I get myself in trouble there. I'm not really sure what's going on there, although they seem like they didn't make many changes, so they're going for something, so they must be going for that wild card spot.
That was from Mike McKee and Tom Keene. They were pushing me to ask Secretary Walsh. They had to go there. It's good to catch up with you, sir. Thank you. Labour Secretary Marty Walsh there on just a killer jobs report. I'll keep going through the price action. Mike McKee's going to drop by again and go through the labour market report after his 5th, 6th, 7th, 8th look at it. We'll get the view of Anastasia Amoroso and Mike Collins of PGI Capital, respectively. We're coming off the lows here. On the Nasdaq, we're down about 0.8%. On the S&P, we're down 5 or 0.6%. In the bond market, just some big moves off the back of a big number. Up 18 basis points on a 2-year to 3.22. Coming up, investors looking ahead now to CPI data next week.
We're looking for another strong gain. So, the headline's going to be weaker just because you had that huge pullback in gasoline prices. But that shift from 1.3% to 0.2%, which is what we're looking for, it almost entirely stems from energy.
That conversation up next.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I think that the business is evolving to have much more customization on clients' portfolios, and that's a good thing, but it's a challenge to kind of move into that mode.
And you're one of the most fascinating entrepreneurs because you also started really young. What did you learn? Did you always think that you'd be an entrepreneur?
Probably, yes. I think, which is a bit sad,
From
isn't it?
age, what, 5,
Well,
6?
maybe, I'm not sure. I come from a family of entrepreneurs, so even though I probably couldn't spell the word and still can't occasionally, it's sort of in my blood. But it's really fun starting a business. And fun growing a business. I feel it's a real privilege. And I started my business officially at 18, but I think I knew I wanted to do it very differently from about 15. But I'm sure it's, if you're surrounded by it, it feels very natural. So yes, it's fun.
And it started how? You started by you went to Florence. It was in Italy and you started handbags.
Yeah, so I knew I was actually given a handbag by my mother when I was about 16, one of her old handbags, and I remember how it made me feel. And I think fashion is fascinating for the mood changing, the confidence boosting aspects, and the sort of tribal aspects of what fashion does. And so I went at 18 to Florence, knowing that was the home of leather goods, which is what interested me. I just wanted to learn, actually, and be surrounded by craftsmen who, I mean, making things is important, and that's going to be very interesting, I think, over the next sort of 10 years. I think the onshoring of craft and manufacturing is going to be fascinating, actually. I mean, I watched the offshoring. I literally saw
and
it,
this is that
and I think we're going to be seeing that coming back to local. We have to. When we're all looking at our objectives in terms of carbon, you know, proximity is going to be key.
When Big Tech reports earnings,
Another big day. Apple, Amazon crushing it.
Bloomberg brings you the headlines first.
Revenue growth falling for the first time.
Missed on every top and bottom line metric apart from one.
This really is a story of strength.
Plus, expert analysis to keep you informed.
We've been waiting for this. The fact that they are not profitable is concerning.
Wait and see, and then like I said, that's about 30 trades done. Pay all winners through scalping. Done basically around 90 minutes. Reading, really.
A few blocks to the Fed on the policy side, and they are not going to welcome this report. It's bad news for them in every single way. It makes the notion that we are neutral comical. It means that they're going to have to go even more. And the markets, you saw from what happened to the inversion of the two stands, is now beyond 40 basis points, is saying that they're going to have to somehow break this economy to bring inflation under control.
That was Mohamed Al-Arian earlier this hour. The US payrolls report coming in hot with a host of data still coming next week. The main event, CPI on Wednesday. Mike McKee
Big one
for more. Hey, Mike.
Hey, John. We have a very strong report that takes care of the mandate for the Fed to bring down unemployment. We come in with 528,000 jobs for the month and an unemployment rate of 3.5%. That matches low in January 2020, pre-pandemic. Average hourly earnings unchanged at 5.7%, and of course now we're 32,000 jobs above where we were when the pandemic started. So all good news for the president and for workers, whether Mohammed's right about the Fed. We'll find out next week when we get the inflation numbers. This week is all about inflation in the economic data. CPI on Wednesday, PPI on Thursday, Friday, import prices. And it's going to be interesting now to see what happens with this Michigan number, whether sentiment
on the trend bar,
because of this, and whether people think it means, along with the gas prices coming down, that inflation is going to come down, and the Fed has a little bit less to worry about in terms.
That's the name of the game.
Still reacting to this one, Mike. This 528. Just to find a word.
Pound dollar also cable trade same
from your standpoint.
Group winner.
I don't have any reason to think it doesn't. There isn't a
10 minutes
factor in the July numbers that should really worry us, but it is odd. It's hard to explain other than companies just hired. You'd think more people went into the labor force so they were able to fill some of those job openings.
And to be honest with you,
so I don't, at the moment, have a good explanation, but fortunately there are people smarter than me who will figure it out.
I'm sure they'll figure it out in the next few hours. Mike McKee, thank you. It's a fantastic number, that's for sure. The president taking a victory lap of sorts, saying it's the result of my economic plan to build the economy from the bottom up and the middle out. It's a favourite line of his. I ran for the president to rebuild the middle class. There's more work to do, but today's jobs report shows we are making significant progress for working families. 528,000. PGIM's Mike Collins, iCapital's Anastasia Amoroso. They join us. Anastasia, you've had a bit more time to digest some of this. Your thoughts on this one?
Well, John, good morning. And I know you don't like the
interpretation
wait
for that.
Good news is bad news, and
wait
I don't
for
either. And I actually think that good news is good news here. And the labor market is still exceptionally strong, and that means that we can't put some of the recessionary fears to rest, and that means the economy is still doing just fine. And the reason why that's good news is because I think there is a path to be had to soft landing here that the Fed so badly wants to engineer. So they're going to run the GDP growth below potential, but they're also going to bring down the job vacancies, but not necessarily the job creation itself. And that should not produce a big rise in the unemployment rate. That should be good news for the market.
Thank you, everybody, for joining me.
The screen right now. But the reason that
Dream
should be
and
good news for the markets is
that's
because
going
if
counter
everyone's
trend because
so
that's what happens
worried
with
about
NFP.
having a haircut
You know,
for
people focus
2022
too much on
and
the
2023 earnings
all they
estimates,
do is not
maybe
pay.
we don't
Miss the
have to do that if we're not
liquidate.
actually going to a recession. So my interpretation here is
Doesn't
this
matter.
is boomy, this is
Still get
solid
back
labor
in.
market,
Say we
and the market
20
should over time welcome that. And by the way,
on the bar.
it's too premature to think about what the Fed is
Go
going to do.
again.
We're still 2 CPI prints away from the next Fed meeting.
No, well said. It's a long road to September. Mike Collins, your thoughts?
Hang tight and wait.
Yeah, Jonathan, I'm really in Anastasia's camp as well. I think people who think good news is bad news are kind of missing the big picture, right? If you just think about
It's good.
the different scenarios out there, we've all been told.
So, yep. Subscribe, hit the like button, and you'll get notifications next, which and obviously have a good weekend, everybody. Trade safe, keep watching trades, keep true scalping, and good luck to see you on the next live stream. And take care.